Recent times haven't been the best for investors. Most major indices are down year over year, and the Federal Reserve has been increasing interest rates for quite a while now. But the best investors, such as Warren Buffett, whose strategy we'll discuss in this video, know what to do despite how dire the economic predictions seem. Subscribe to Free Investing and let's get started. The Fed hasn't stopped tightening financial conditions yet, despite the turmoil resulting from the Silicon Valley bank collapse and the recent shakeup of regional banks. It is important to note that the last time we had similar interest rate hikes, the economy went into a deep recession. Unfortunately, this is the economic reality every investor has to face these days, and the outlook is not better with the Federal Reserve anticipating higher rates going forward. Now, one may ask, what is the effect of increased interest rates on the economy? Apart from decrease in inflation, which is the reason for the interest rate hike in the first place, there are also other far-reaching effects increased rates have on the economy, such as 1. Higher costs of borrowing, 2. Reduced consumer spending. Now, for the investor, this means three things. 1. Bond prices go down, making them more attractive. 2. Higher returns on savings, leading to more of that type of behavior. 3. Stocks taking a hit because they, having risk by nature, now have to compete with higher risk-free savings rates. So, how do we invest in this situation, which is the reality for every investor in 2023? In this video, we will turn to some age-old advice from the Oracle of Omaha, Warren Buffett. Warren Buffett is the world's most successful investor, and his algorithm for picking stocks can be summarized in 3 steps. 1. Identify companies with strong and enduring competitive advantages, moats, and make sure to understand them well. 2. Buy in heavily for an attractive price when the economics of that business are strong. 3. Hold your investment for the long term. Now, Buffett's approach to investing looks simple, but beyond the 3 steps, one important component of his investment strategy is temperament.
Occasionally, Berkshire gets a chance to do something, and it's not because we're smart. It's because the only thing I'd say we qualify on, and sometimes I wonder about that, but I think we're sane, and that's the main requirement in this business.
In this regard, Buffett stated in his 1996 letter to Berkshire Hathaway investors, "You should entirely avoid owning stock if a crashing market would lead you to panic and sell." In that letter, he also stated that selling fine businesses on scary news is usually a bad decision. And to buttress this point, he told the story of Robert Woodruff, the business genius who built Coca-Cola over many decades and owned a huge position in the company. Woodruff was once asked when it might be a good time to sell Coke stock. He had a simple answer: "I don't know. I've never sold any." Buffett's explanation makes it clear that one might buy the right stocks with the right strategy, but lose it all with the wrong temperament. He also further explains what he calls the 3 philosophical benchmarks in approaching the market, which includes your attitude towards the market, your margin of safety, and viewing stocks as businesses.
There's 3 important aspects to it. One is your attitude toward the stock market. That's covered in Chapter 8 of The Intelligent Investor. I mean, if you've got that attitude toward the market, you start ahead of 99% of all people who are operating in the market, so you have an enormous advantage. Second principle is the margin of safety, which again gives you an enormous edge and actually has applicability far beyond just the investment world. And then the third is just looking at stocks as businesses, which gives you an entirely different view than most people that are in the market. And with those 3 sort of philosophical benchmarks, the exact evaluation technique you use is not really that important, because you're not going to go way off the track, whether you use Walter's approach or Walter Schloss's or mine or whatever.
For those who do not have the patience to deal with the ups and downs of the market, such as we are experiencing in 2023, Buffett recommends passive investment. So, what passive investment does Warren Buffett recommend? Well, Buffett's top pick is buying index funds. According to the Oracle of Omaha, all you have to do to invest in index funds is believe that America and American businesses will do well in the long run.
So this time I went back actually to 1942 when I bought my first stock as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amounted to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776. And that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
In his 1996 letter to Berkshire investors, Warren Buffett suggests that for most investors, the best way to own common stocks is through an index fund that charges minimal fees. He believes that those who follow this path are sure to beat the net results delivered by the great majority of investment professionals. But the big question here is, how much does Buffett believe in investing in index funds? Well, he sure believes in it enough to give the same advice to NBA star LeBron James.
My first question would be, what should I invest in next? Can I have some tips?
I think somebody like LeBron, and we've talked about it, but actually if through the rest of his career and beyond in terms of earning power then, just making monthly investments in a low-cost index fund makes a lot of sense. I think that somebody in his position ought to have a significant cash reserve and whatever makes him comfortable. And then beyond that, owning a piece of America, a diversified piece, bought over time, held for 30 or 40 years, it's bound to do well. And the income will go up over the years, and there's really nothing to worry about.
As far as the Oracle is concerned, investing in index funds is equivalent to owning a diversified piece of America for a long period of time. Quite impressive. Beyond the investment advice to LeBron, Buffett believes that the hedge fund industry charges exorbitant fees that the fund's performance historically can't justify. And so it's not surprising that investing in low fees index over time tends to yield more profit than owning a portfolio with a hedge fund manager. In 2008, Buffett issued a challenge stating that including fees, costs, and expenses, an S&P 500 index fund will outperform a hand-picked portfolio of hedge funds over 10 years. The bet was for $1 million, and Protégé Partners LLC, a hedge fund outfit, accepted the challenge. By the end of 2016, Buffett's index fund bet had gained 7.1% per year, or $854,000 in total, compared to 2.2% per year for Protégé's picks, just $220,000 in total. The index fund Buffett used for the wager was Vanguard S&P 500 Admiral Fund, while the fund of funds has not been publicly named. Whatever the case, Ted Sides, Protégé's co-founder, conceded defeat in a Bloomberg op-ed where he stated that, for all intents and purposes, the game is over. I lost. Buffett's little wager is clear proof that investing in index funds, such as the S&P 500, over time produces positive yields, even better than hedge funds. Applying this investment strategy over time by dollar-cost averaging a part of your income can yield great results with enough patience. By saving and investing regularly, you are buying stocks at different prices over time, which reduces the risk of poor market timing. Now, if you choose to throw your hat into the ring and set up an investment portfolio, Warren Buffett has some advice for you from his 1996 letter to Berkshire Hathaway investors. According to Warren Buffett, one of the most successful investors of all time, intelligent investing is not complex, but it's also not easy. To be a successful investor, you need to be able to evaluate companies within your circle of competence. You don't need to be an expert in every industry, but you should know the boundaries of your knowledge. Buffett writes, You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. Buffett also explains that you don't need to understand complex financial theories and concepts. Instead, he suggests focusing on two subjects: determining what a company is worth and your attitude towards the market. He says, to invest successfully, you need not understand beta, efficient markets, modern portfolio theory, option pricing, or emerging markets. You may, in fact, be better off knowing nothing of these. That, of course, is not the prevailing view at most business schools, whose finance curriculum tends to be dominated by such subjects. In our view, though, investment students need only two well-taught courses: how to value a business and how to think about market prices. The goal as an investor is to purchase a part interest in an easily understandable business for a good price, whose earnings you expect to be materially higher in the future. When you find a company that meets these standards, you should buy a meaningful amount of stock and resist the temptation to stray from your guidelines. Buffett's approach has produced wonderful gains for Berkshire Hathaway shareholders over the years. Their combined profits have grown and their stock price has risen correspondingly. The company has continued to push in the same direction by building earnings through their present businesses and purchasing other businesses with durable competitive advantages. In fact, Warren Buffett's portfolio has made a compounded annual gain of 19.8% between 1965 to 2023, which is about double the S&P 500's 9.9% in the same period. It also made an overall gain of about 3.7 million% as against the S&P 500's 24,708% in the same period. Now, let's go back to the economic realities of 2023 and beyond. In other words, high inflation, which has led to the Fed hiking interest rates and therefore slowing growth. Everyone sure does feel like a genius in a bull market, but the rallies like we've seen in 2020 and 2021 don't last forever. However, there are proven steps recommended by Warren Buffett to stay afloat, even with the bleak economic conditions we face. First of all, periods of slow growth in the market are good opportunities to load up on high-quality companies. This follows the idea of buying into the market when the prices are low. If you look at the Dow, for example, the periods of historical drawdown are always followed by a rebound in the market. What better time to buy stocks than during these periods, right? Anyway, what is Warren Buffett's recommendation for investing during inflation? The first thing is to see a stock as part of a business. This means analyzing businesses before buying their stocks, and it's a cardinal part of Buffett's investment strategy. When applying to this case, it means that before buying stocks during inflation, you should look into companies that are well adapted for an inflationary environment. Such enterprises typically aren't capital intensive and have pricing power. How do we identify these companies exactly? Well, Warren Buffett gave a detailed explanation of the criteria such companies must meet in his 1981 letter to the Berkshire shareholders, when the economic situation had similarities to what we deal with today. First, an ability to increase prices easily, even when product demand is flat and capacity is not fully utilized, without fear of significant loss of either market share or unit volume. For example, a company like Apple can increase prices much more than the competition while still maintaining its market share, because everyone wants an iPhone. Coca-Cola can also afford to increase the pricing of its products during inflation and still maintain market share. This is because consumers are loyal to these brands and are unwilling to try out others. As a result, such companies are less likely to be heavily impacted by inflation. The second criteria is an ability to accommodate large dollar volume increases in business, often produced more by inflation than by real growth, with only minor additional investment of capital. A company that can accommodate a large dollar volume increase with minor investment is one that can generate more revenue with little investment. For example, tech giants can create new revenue-generating features for much less than it would cost a car company like Ford to design a new model of a truck and achieve high-volume production for it to become profitable. In the 1981 letter, Buffett concluded that managers of ordinary ability, focusing solely on acquisition possibilities, meeting these tests, have achieved excellent results in recent decades. So, in the end, focusing on the company rather than the general market performance can help you get ahead as an active investor in a market blighted by inflation. Besides that, Warren Buffett also notes that investing in yourself, your own talent, and skills is the best thing you can do. This would increase your earning and therefore purchasing power, helping to alleviate inflation's impact on you and your family.
Yeah, well, the best businesses during inflation are usually the best. They're the businesses that you buy once, and then you don't have to keep making capital investments subsequently. So you do not face the problem of continuous reinvestment involving greater and greater dollars because of inflation.
Now, gold has been touted by many as a great hedge against inflation, and many people buy into the idea of protecting their assets from inflation by buying gold. But Warren Buffett begs to disagree. He believes that gold is an asset that doesn't produce anything and says that buying it means betting that another person would be willing to pay more for it than you did previously.
Anytime you buy an asset that can't do anything, produce anything, you're simply betting on whether somebody else will pay more for, again, an asset that can't do anything.
Finally, how do you invest in times of interest rate hikes? Warren Buffett says that interest rates govern everything. According to him, low rates make any future stream of earnings from investments worth more money. So invariably, with high interest rates, our investments are worth less money.
The most important item over time in valuation is obviously interest rates. I mean, if interest rates are destined to be at very low levels, not necessarily as low as they are now, but very low compared to 100-year averages or 50-year averages, it makes any stream of earnings from investments worth more money. The bogey is always what government bonds yield. Now you can pick your maturity.
It's important to understand that interest rates are the cost of borrowing money. When they are low, it becomes cheaper for businesses to borrow money, which can stimulate the economy and encourage investment in the stock market. When interest rates are high, however, borrowing money becomes more expensive, which can slow down the economy and make it more difficult for a business to invest in growth. As a result, investors may become less willing to put their money in stocks, which lowers their value. In addition, higher interest rates also make bonds and other fixed income investments more attractive to investors because they offer higher returns. This can cause some investors to move their money out of equities and into these other types of investments, which also make stocks go down. Although bonds might be attractive in this scenario, Warren Buffett makes a strong case for still choosing stocks over bonds for the long term when interest rates are high.
That's why I've said for a long time that equities were the place to be. I mean, there's been no comparison. To me, it's just been absurd to see pension funds and those people in the early teens of this century saying we ought to have 30 or 40% bonds. There's no comparison. A bond that pays you 2% is selling at 50 times earnings, and the earnings can't go up. And the government has told you we'd like to take that 2% away from you by decreasing the value of money. That's absurd to own something like that. You may have to own it for legal reasons or something of the sort. But to make that as a voluntary choice in the last 10 years against owning assets has struck me as absolutely foolish.
In the end, in a high interest rate scenario, equities offer higher potential for growth and returns than bonds, according to Buffett.